Hey folks, welcome to CFO Chat. The banking season full year numbers for FY24 are beginning to roll, and of course, as always, the first kid off the blocks is Stanbic Bank, and guess who we have on set? None other than Dennis Musau, Chief Finance and Value Officer at Stanbic Bank. Karibu sana, Dennis.
Asante.
Always a pleasure. Dennis, it looks like a mixed bag for me. I like your net earnings and the growth. I like your dividend. I like your return on equity. But when I peel through the numbers and now begin unpacking it, I have a number of questions for you. First of all, if you look at your loan book, sizable reduction. I appreciate there might be an FX element there playing out.
Yeah.
But really, what happened in Q3 and Q4?
Yeah. So a mixed bag is a good characterization. But the year itself was mixed. So
It follows that your numbers should be mixed.
You can't have a kind of a straight performance in a year that saw episodic but material events. If you start in February, you discuss a massive currency correction that happened. Then you move closer, you get into floods, which impact supply chains and impact agriculture. Then you move closer, you get into protests, which have an implication on trade and business confidence. Then you're moving towards the end of the year, and you've got, all manner of uncertainty. So it was a mixed year. But Julians, real generals are made during times of war. And when there is uncertainty and crisis, that is really when you prove that you're resilient, that you've got a good business model, your customers have trust in you, and they want to do business with you. So what happened on the balance sheet? Our balance sheet started the year about 459, 460 billion, closed 455 billion. So I would characterize the balance sheet as largely stable. In between the lines, you will see quite a bit of movements. Yeah. Our loan book reduced 12%, in absolute terms, about 30 billion shillings. Out of that 12%, 8% is currency appreciation. So currency corrects 45% of the balance sheet is in foreign currency, and therefore you start to see that pull back in terms of absolute numbers. The rest is basically seasonal. And you are right. Actually, when you trace our balance sheet quarter on quarter, you start to see a significant spike in Q1, then muted growth in Q2, then also a spike in Q3, and then a Q4 reduction. What happened? We are now participating in the OTS arrangement. And those facilities are short-term, but also massive. So when the LC is on your balance sheet, it implode. You see your customer deposits tick up, you see your loans tick up. And then when they unwind, because if there's a settlement period, then it leaves. What for me is comforting is that throughout the year, we actually saw our balance sheet expand by 13% year on year.
Yeah. All right. And still on the balance sheet side, I noticed a contraction in your deposits. But then if you look at the increase in the interest expense, it is quite outsized vis-a-vis what you're seeing on the deposits. 2024 must have been a very challenging funding year for Stanbic and banks by and large.
Yeah, so I would say balance sheets were largely anemic of local currency funding in 2024. There was heightened government borrowing, at least for the better part of the first part of the year. Yields in the market were good, and therefore people looking for yields had multiple options.
Yeah.
And therefore, generally, you saw a lot of banks kind of price up. Actually, when I did the Q3 analysis of banking industry, only one or two banks hadn't seen a significant increase on their interest expense on customer deposits. So your observation is absolutely right. But I'm actually very happy with something that we did. So We do run some pricing models within the bank, and we thought carefully about how we're going to transmit that extra cost of funding to our customers.
Yeah.
And we're very careful about how much we can push. So you will see our gross interest expense grows by 93%, but our interest income only goes up by 27%. And if I can jog your memory, in 2023, our gross interest expense increased by 72%, but our interest income increased by 45%. So this is not a new thing we've invented. We're very careful about how much cost of funding we can transmit onto the price without tipping the customer. So that's part of what actually ended up squeezing our NIMs. Could we have done more NIMs? Yes, but at what cost? At the cost of
more
tipping our
defaults,
customers,
exactly.
At the cost of credit defaults,
Yeah.
at the cost of higher impairments, and basically just squeezing the customer wallet even further.
But Dennis, even as you speak about that, would you say that the architecture of your loan book becomes a constraint? Because I would have expected, the environment notwithstanding, Stanbic would have extracted a bit more from the NIM side, especially given the sort of environment we were in. Is the fact that you have a lot of your very heavy foreign currency in your book a constraint?
It is not a constraint. Remember, your balance sheet is an outcome of your strategy. So we have chosen to operate in certain sectors. We've chosen to operate with certain clients. And those clients actually give us the balance sheet that we have. And not so long ago we spoke about how heavy our balance sheet was on the FCY side. Now market dynamics change. The client hasn't changed, but the market dynamic has changed. And one of those that has changed, of course, is the oil importation arrangement, which has moved that demand for balance sheet from foreign currency to local currency. Does the supply of foreign currency become a problem? No. If anything, it is actually an advantage because we are finding new opportunities to redeploy that balance sheet. If I can give you a statistic, when this whole arrangement came in, our FCY, our foreign currency loan to deposit ratio dropped to just under 40%. It's now ticked up to over 60%. So we found new opportunities to serve clients differently. Of course, FCY rates coming down is also helping. So we're seeing that demand coming through. The LCY side, I will partly accept that we could have milked more if we were heavy on the local liability funding. But I think it's a choice we made because we could have said to the customers, look, we had structured ourselves to serve you in FCY. Now we don't have, now you've switched your demand to the other currency and therefore, sorry, we can't serve you. But we chose to continue serving them, yes, at a higher cost of funding, but to maintain that strategic relationship because we believe our arrangement and our engagement with clients has to transcend some of these cyclical movements.
Okay. You had some serious bump up in your interest from government securities, and you've spoken about the sort of environment we had from a yield perspective. But I wonder, was this fundamentally a liquidity play, or was there a substantial shift in strategy here?
Largely a liquidity play. So if you look at the balance sheet itself, you will see almost a doubling of financial investments, right? But if you break it down into the various classes, what we hold to maturity, what we are available for sale, and what is fair value, basically trading purposes. The biggest movement is in that trading piece, which is basically holding for short-term profit taking, but also awaiting redeployment into client franchises. And that also correlates to the fact that customer assets were down. Deposits were relatively flat, 1% down. Customer assets down 12%. So that creates extra liquidity. As you wait to redeploy that, you put it onto government instruments, trading capacity, and then you unwind them as a client demand comes through.
When you look at your income lines and specifically your non-interest income, and I wonder, Dennis, can we still be speaking about base effects in the sense that we had a huge transaction earlier and that's why it's reflecting on contraction? Never mind, Dennis, last year, You also had a big transaction in December.
Yes. You know, an elephant is a big animal, but so is a wildebeest. But they are not the same size.
There's relativity there.
Exactly. So we did have big transactions in both years, but one was much bigger than the other one. No, I mean it's just the quantum of the transactions that we had. The fee that we earned in the first transaction was much bigger than the fee we earned on the second transaction. More importantly, at the time the first transaction happened, FX margins were very high. Yes.
Yes.
At the time the second transaction happened in December 2024, margins were back to what we call normal. And therefore, the FX kind of trading forex income that we made on the second one was much smaller. So two different animals in quantum, but also timing.
Dennis, we've had a lot of conversation around risk-based pricing, and especially in view of the changes we've seen in the benchmark rate for the Central Bank of Kenya. Banks, including yourselves, have put out statements indicating we have revised. I put out a question on X and it elicited so much conversation. Is there a case for a unified reference rate across banks as opposed to each bank having its own base rate that is using as a reference? What do you think?
So we have approved models first, which we follow.
Yes.
We would like to follow until otherwise
Guided.
Agreed with the regulator. The current models work, and like any model works when things look a certain way, but then it becomes problematic or may not work when certain aspects change. So one of the known challenges with our cost plus model, which is what we use today, is that it lags. That's a reality. You know, when when the CBR was bumped up by 200 basis points in November or December of 2023, you didn't see an immediate jump in rates. If anything, we actually only corrected. Our costs only build up, and we were able to correct towards May of 2024. So you can see almost a 6-7 month lag. And that's just an example. The truth is, when the CBR has been correcting downwards or has been moving downwards, there's also a lag. And the biggest debate we've had is, how do you create consistency in how you manage that? So there is an industry conversation that is going on how we think about some of the principles you're sharing around one reference point, not necessarily one price, but a model that helps transmit monetary policy and market trends much faster than we are currently seeing. But would I fault the models we have? Not necessarily. We didn't have them before. We had interest rate capping. We had a problem with it. So I think the conversation that is there today, because banks have been applying the new models for the last 1 year, 1.5 years, is what lessons have we taken from this, especially because we've seen the interest rate cycles, and how do we adjust the sales to ensure that we meet, most importantly, the client demand.
Interesting. You seem to be bang on in terms of a number of the metrics you're targeting for your current strategy cycle. I've checked your cost to income. You seem to be in the mid-40s. That kind of looks like a sweet spot. Your return on equity, you are quickly edging up towards 20%.
Yeah.
It looks like you're on to some very good takeoff on your year 2 of your new strategy.
We are, and we remain very optimistic about what we've chosen to do. Our strategy is very selective on the things that we want to do, but also very clear about the things we don't want to do. And the evidence I have seen in our first year, of course, building off the strategy that we had between 21 and 23, is that I'm already starting to see green shoots in terms of the things that we had chosen to do and how we have executed them. It is very rare that, and before I joined banking, I was in the consulting world for a long time. It's very rare that you do a core banking upgrade and there is no noise. And for me, the pride is that we upgraded our core banking platform 6 versions, with no noise. We revamped our mobile platform, release it out there. It's being used by customers. So the way we've chosen to do our strategy, mostly on the digital tenancy area, I am very, very happy with how we are executing. I'm very happy with how we are extracting internal efficiencies. Not so long ago, you and I sat here and discussed a cost-to-income ratio of just under 50%.
Correct.
We are now actually talking about 44%, and that's actually an increase from last year's 43.4. So very, very comfortable with the things that we are doing, but most proud of the impact that we are leaving as we execute strategy. For me, when we say we are financing infrastructure development, when we say we are creating financial inclusion, we have an arrangement with one of our partners where we are targeting hundreds of thousands of women to empower through some of our platforms. We are creating bankability for the unbankable. There are people, when you put them through our credit scoring models, and not just ours, just industry, because of CRB and all these things, they fail. And we are creating platforms where those people can actually start accessing small credit, and then they graduate into full commercially lendable people. If we do nothing else and deliver on that impact, I think we have lived our purpose.
Okay. One of the major developments in the market, Dennis, has been, for the first time in 4 years, we've seen 100 bips slash in the cash reserve ratio. Curious to know what this means for you. How much in liquidity is it unlocking for further lending by Stanbic?
So of a 300 billion deposit base, about 3 billion, which is good. And I have to applaud our regulator. They've been very clear about the things that they want to see in the market. Anchoring of inflation, now making credit a lot more affordable, increasing liquidity in the market, correcting what we see as negative private sector credit growth. So for me, all that, the horizontal summation of that is a responsive monetary policy that is driving the outcomes that we want to see. For us as a bank, this means more liquidity available to our customers, and we are out there supporting our clients with that extra liquidity.
Final question, Dennis. South Sudan seems to be bleeding quite a bit. And even the numbers that you presented this morning, pre-hyperinflation adjusted. What's the strategy on that side?
So our strategy on South Sudan has not changed. We want to continue doing FX intermediation and payments facilitation. Like any other market, you will go through winter, but summer is coming. When winter is,
we hope
summer is coming. The pipeline was disrupted because of the challenges up north. We are reliably informed that has since been fixed. In fact, oil production has largely restarted. We expect the first exports to happen in April/May when the pipelines have been cleaned. So we think that's going to correct and come back up. I am we are incredibly proud of the team we have in South Sudan. That despite that kind of a market dynamic, where others would have given up and said, this is never going to work, and etc. The team has continued to serve our clients. Our clients still give us very good support scores or service scores when we talk to them. So they understand that we have chosen to do something with them. We will do it to the best of our ability, and we both manage the market dynamic.
Allow me to ask the final one. Agatha, yes. Is the final one.
Yes.
I think I saw something close to $1 billion worth of FX adjustment in the numbers. 700 million thereabout. Mm-hmm. Could you just give us more color into that?
FX, just help me understand, FX adjustment.
So in the investor presentation, we were discussing, I think it was the loan book? No. Mm-hmm. There was 700 million worth of an FX adjustment.
I'll tell you. Yeah. I think I know what you're talking about. It's impairments.
Impairments, correct.
So on impairments, we have shown an impairment charge of 3.1 billion, 3099, if you follow the investor presentation. And I mentioned that impairment would have been 3.7 billion, were it not for FX appreciation. Now, 45% of our NPLs, or non-performing loans,
is hard currency.
Is in FCY. So when the currency compresses, and because we carry the FCY equivalent of Kenya shillings in impairments, then it gives you kind of a credit note on the impairment.
Dennis, I can't close this conversation without allowing you to speak about your dividend. We always start with it when it is in a bit of headwinds, but this time it is pretty good. Yes. So go for it.
Have you seen the share price? So look, I love the way our board kind of balances and thinks about how we balance our stakeholders. And I know I've said this before, but we've got multiple stakeholders. We've got our staff in the office. We have a way of dealing with our staff and remunerating them. We've got a community, which I've spoken to, and how we deal with community and how we are continuing to serve our communities. We've got our clients, who we continue to invest in serving and availing platforms and services. And then we've got the government, and we do pay our fair share to the government. And then there's the shareholders. Now, if you look at this in numbers, if you bought our share, if you bought the Stanbic share on 1st of January of 2022, which is 2 years ago, you would have bought it at 102 shillings.
Yeah.
Today, that share is just shy of 160 shillings. So you've made
some good capital uplift.
About 50%, right? In that same period, we have paid a dividend of about close to 40 shillings. So 15.35 last year, 20.74 this year. So I couldn't be prouder of how we are valuing our shareholders, ensuring that they get a fair return on what is scarce capital. And these shareholders have given us 75 billion shillings worth of capital to work with. So here's to say grateful to our shareholders, and we do hope to return more in coming days.
And the third problem of that is actually that your dividend yield makes for some very good return, competing with other asset classes we have in the market, which Kenyans are running for, including the money market funds. Okay. We have been having a conversation with Dennis Musau, Chief Finance and Value Officer at Stanbic Bank, unpacking FY24 numbers. Remember, the season has just begun, so all the banks will be on this platform unpacking their numbers. Stay tuned to CFO Chat.